All right, hello and welcome to Camel Finance. I'm your boy Camel, and today we're going to be talking a little bit about cryptocurrency news. I've got some cool Bitcoin stuff to show you. Then we're going to be looking at a little bit of traditional finance, and then a little bit of liquidity, because liquidity is the ultimate story at the moment. Liquidity is what is going to be needed to drive this market higher, and I think liquidity is also going to be the story that wrong-foots the most amount of market participants. And then lastly, we're going to look at the charts, because we've really reached an inflection point. The closes today, the closes on Friday, will set us up for either what was a massive bull trap, or it will set us up for confirmed breakouts ready for major upside next week. So it's really important to see how the closes finish the week. We have a lot of economic data coming out today. There's PCE, there's consumer spending, and a few other bits. So it could well be a choppy session. But like I said, we really need to see the closes. And once we've got the closes, we'll know whether it's time to get very bearish or expect major upside through April. So starting off with some Bitcoin news, MicroStrategy is holding a Bitcoin and Lightning for Corporations conference in the start of May. So MicroStrategy is planning to train or to roll out or to aid and assist these corporations with integrating Bitcoin and the Lightning network into their corporations. So this should spark massive adoption through the corporate sector. And I also expect this to be a net positive for the MicroStrategy price, as ultimately they will benefit financially from onboarding clients. As I often say on this channel, Bitcoin doesn't care. And here is a perfect example of this. The CFTC sues Binance, and within just a few hours, Bitcoin's price has not only recovered, but it is holding above the level in which the breakdown occurred. Latin America's biggest e-commerce platform, Mercado, now offers Bitcoin trading to customers in Chile. So again, we continue to see adoption, and I'm sure we will continue to see continued adoption. 73% of all on-chain Bitcoin is in profit, denoted by a green dot here. Notice we go from green to yellow to orange and then to red, and the red usually, or at least historically, has marked the tops for the Bitcoin price. This suggests there's still a fair bit of upside left ahead of us. Meanwhile, the Bitcoin hash rate is absolutely ripping. It continues to set new highs. So you can really see now that these large entities, and I would speculate institutions and banks, are starting to figure this out. They're starting to figure out that there's only 1.8 million Bitcoin left on exchanges. There's only around 1.8 million left to be mined, and they will not be all released into the ecosystem until 2140. So getting a leg up against the competition by gaining hash rate now will certainly pay dividends in the long term. Remember, there are 60 million millionaires worldwide and only around 3.6 million Bitcoin up for grabs. Remember Balaji's bet that we would reach $1 million Bitcoin by June the 17th, which was a 90-day window from the time that the smart contract bet went live? Well, somebody worked out that Bitcoin would need to go up 4.56% every single day for the next 80 days straight to reach $1 million by June. So is this possible? I think anything's possible. Is it likely? I'm not too sure. We certainly need to see the dollar absolutely implode for this to become a reality. But never say never, right? Over in traditional finance, things are starting to get more bullish. So this is the 11th week bull bear poll, and you can see here that for the first time in a long time, people are more bullish over the next 3 months on the S&P than they are bearish. Note that this is only marginally above 50-50. So for all intents and purposes, you could call this 50-50, but sentiment is changing. Sentiment is changing. We are slowly seeing more bulls come back to the market. We're slowly seeing more bears capitulate. And speaking of bears capitulating, we had one of the biggest perma bears of all time, Michael Burry, come out and say he was wrong to say sell. First of all, props to anyone that can admit their mistake. This is an absolutely imperative quality to have as a trader or an investor. You have to be able to accept the fact you will get things wrong all the time, and it doesn't matter so long as you're able to admit your mistake. I'd also like to point out that there's a whole slew of people on Twitter yesterday coming out and mocking Michael Burry, saying, ha, he was wrong. And everyone loves to point the finger when people are wrong. Everyone likes to say, ha, that guy was wrong, that guy was wrong. But understand this, not many people came out at the time and said, I think he's wrong. Now, I was one of those people. You won't have seen this video because it's only got 63 views, but I made a video here and I said he clearly sold the bottom. And again, being right or wrong is not important in trading or investing. What's important is understanding that you're going to be wrong around half the time. You're going to be wrong around half the time, and that doesn't matter so long as you have no emotion, no ego, and are able to just stay on the right side of the market based on what the charts are telling you. As I said in the intro, global liquidity continues to be the story here. Global liquidity continues to be the factor, in my opinion, that is going to drive markets higher and wrong foot the majority of market participants. Global net liquidity continues to surge, leading the stock market, as you can see here. Liquidity in blue, stock market in orange. And as a result of this liquidity, we're seeing the Nasdaq up 17% this quarter. I think as of yesterday's close, we're up 20% this year, which is the second best performance in a decade. All thanks to the Fed and Powell and their increase in Fed liquidity, their increase and expansion of the Fed balance sheet. And speaking of the Fed balance sheet, here's a very interesting look. The Fed balance sheet on a log chart. Do you see this tiny marking in yellow right here? That is the great quantitative tightening that everyone was talking about a few months ago. Remember how the Fed would quantitatively tighten, i.e. remove liquidity from the market by shrinking their balance sheet, by reducing the amount of assets they hold on their balance sheet until the market crashed? Well, as you can see, barely even a drop in the ocean. And remember, after a full year of quantitative tightening, they reversed almost 70% of it in a week and a half. The next stop is 16 to 20 trillion into 2025. And as if that's not bad enough, as if this is not going to debase the dollar enough as it is, what we're now seeing is the latest government report is out and the US Treasury cash balance just reached another recent low. They only have $187 billion left. So keep in mind that February's deficit alone cost $262 billion. What does this imply? What this implies is we're setting up here for a double whammy of dollar debasement. First of all, we have the Fed increasing their balance sheet via this thing they call not QE, but ultimately, make no mistake about it, they're going to print money, and that money that is always printed has to go and find yield to protect itself against the debasement of the dollar. So it does that by moving into risk assets. Some of this money always finds its way into the stock market, as I showed you earlier, here and here. But why this US Treasury cash balance is so important is because once we get down to these local lows, they're going to have to issue more treasuries. They only have $187 billion left, and the deficit in February alone was $262 billion. So what does this imply? Well, if they're going to issue more treasuries, how exactly do they do that? Well, of course, they print money out of thin air and they issue it in bonds. They monetize their own debt. So in addition to printing money and buying stocks with it to expand the balance sheet, they're also going to be printing money to issue bonds and attempt yield curve control. This is an absolutely monstrous setup for the dollar at the same time as we have nations all around the world moving away from the petrodollar system, removing the demand for the dollar. And speaking of the dollar, here it is, still contained under this downward sloping red resistance line, still looking for lower lows, all the while we're contained under here. Some kind of breakout on a daily closing basis would set up an upside counter trend move before then what I believe will be rolling over because of the factors I've already told you about. We have the de-dollarization moving off of the petrodollar system, removing demand for the dollar. We also have the treasuries about to be printed out of thin air, and we have this program called not QE, where they're currently back to expanding the balance sheet. Bond market still not making up its mind, is it? So this kind of looks heavy to me, but I absolutely couldn't say with any level of certainty that we won't have a pop-up here before then breaking down. And the exact same thing is true of the US government 2-year yield. TLT continues to trade in a range, so nothing more to say about that. Things are heating up in the stock market. Now, this could certainly be a bull trap that rolls over into that daily cycle low before we then have an attempt at moving higher. But for now, undeniably, we're above this yellow short-term uptrend, which admittedly is quite steep. We've recovered this red upward sloping support line, and we've broken out of our downward sloping purple resistance line. So all the while we're above this neighborhood here, it's reasonable to expect further upside for the S&P 500. The Nasdaq is even more bullish, as you can see. Broke out ahead of time, that's where the trigger for the long came from, and now we're above this local high here. Now again, it doesn't preclude a move lower to create some kind of a bull trap here if the data today that comes out is bad, PCE and consumer spending. But of course the inverse is true as well. If that data comes out better than expected, it's likely that we'll see this continue to trend to the upside. I think an upside move here is the pain trade at the moment. I think that is how you would upset the most amount of market participants. At the same time, the Dow has broken out. Look at the Dow go. So again, this could roll over, things can change and they can change quickly, but all the while we're above this line of repair here, then it's reasonable to expect further upside from the Dow. The Russell 2K still hanging out in no man's land, as is the FTSE 100, and the VIX remains on a 19 handle. So when I said at the start of the video, these breakouts can either be proven to be confirmed on a weekly time frame after the closes on Friday, or they can set up a bear trap ready for next week. So here's an example of what that would look like. If we close somewhere in this neighborhood, then inarguably on a weekly time frame, let's go to a weekly chart so we can be clear. We will have broken out of this downward sloping purple resistance line, recovered the upward sloping red support line, and be looking for continued upside next week. And of course, the same will be true of all of the indexes. However, if I hop back into a daily chart and we get some kind of setup like this that closes today, then you have to remain unbiased and objective, and all we would be able to interpret this as was a failed breakout, a false dawn, and we would have to be open to seeing further downside into the next daily cycle low. Tesla looks like it's thinking about breaking out of this downward sloping green resistance line, but it hasn't done it yet. Apple is starting to move up out of its breakout of its box, so perfect retest with a little bear trap followed by resumption higher. I also noticed you can draw a trend line connecting these wicks. It's a bit scuffed, but it looks something like this. So has it broken out of this? All in all, I like what I see out of Apple. Long and strong continue to push. Bitcoin still consolidating. In my mind, Bitcoin is probably going to set up for some kind of bear trap before then resuming higher. That's kind of typical of what Bitcoin would do. But all the while we're above this yellow horizontal line, we still have a confirmed range breakout. So I have been talking on and off about a back test of this before then moving higher up into that next cycle low. So I'm still open to seeing a pullback to this range breakout. For now, it's a case of remaining long and strong and seeing what the market can give. Ethereum still hanging around, not doing a whole lot of anything. And XRP continues to kind of hold this 53-cent range. So it'll be really interesting to see whether we get some kind of breakdown of this yellow trend line followed by a pump back up and some kind of distribution pattern. If we do, that will be, to me, a sign that it's time to get out of this trade and expect this thing to nosedive. However, we also have to be open in the short term to seeing this thing. You can see if I zoom out a bit here, there's still potentially massive upside ahead. So I don't know which way the market's going to go, of course. I just have to trade the chart in front of me. So for now, we're long and strong. I am open to seeing some kind of distribution and topping pattern here. That would make me feel uncomfortable with continuing to hold the long. So I'll be looking for breakdowns if we get that some kind of sideways chop in here. The precious metals, still looking to see if we can get a flush, one last dive down. So can we, can't we? That, of course, remains to be seen. Same is true of silver. I would not be surprised to see something like this occur in here. But of course, as ever, take it one day at a time. I'm sure massive opportunity is going to be coming up for both gold, silver, and the miners in the not too distant future. But patience is the #1 tool in an arsenal of a trader. And so that's the video today. I hope you found value here. I hope you enjoyed it. As I said, for me, it's just about, I'm not paying too much attention to the PCE data because we're just in this world of fake data, manipulated calculations. And also we're in this world where liquidity is likely going to trump everything. So good news could be bad news could be good news. I'm just going to be looking at the technicals. Like I said, I want to see how the weeks close. I want to see if we can confirm some breakouts on the weekly time frame, which of course would set up further upside next week. But conversely, if we get some kind of bull trap form and then we lose all of the breakout levels into the closes of this week, then we will have to be open to reducing long exposure on the equities and looking for downside in the near term into that next daily cycle low. So trade safe out there. Hope you're doing well in life. In the meantime, take care from me. All the best. Cheers. Bye.